Did you know that by the end of 2021, nearly two of millennials were already millionaires, and many of them started with only a smartphone and a strategy? Today, I will show you how investing in your 20s isn't just brilliant, it's potentially life-changing. Whether you've got $100 or $10,000, it's time to turn your financial dreams into your future reality. Let's dive into the world of millennial millionaires and unlock the secrets to investing in your 20s. Welcome to Money Craft Masters. If you think investing is just for the wealthy, think again. The truth is, the earlier you start, the better your chances of joining the Millionaires Club. Thanks to the magic of compound interest, I'm here to guide you through the maze of investment options, strategies, and tips to get your money working for you around the clock. Let's start with the basics. Investing isn't just about buying stocks on a hot tip, it's about setting the foundation for your financial future. Stocks, bonds, mutual funds, ETFs, these aren't just buzzwords. They're tools in your investment toolkit. And the cornerstone of all this? Compound interest? It's why someone investing $5 a day from their 20s can retire wealthier than someone who starts later with more money. Now, before you rush off to buy your first stock, let's talk about goals. What are you investing for? A house? Early retirement? Financial freedom? Your goals will shape your investment strategy. And remember, investing isn't a one-size-fits-all deal. It's personal. Your strategy should be as unique as you are. All right, let's shift gears and talk about where to park your hard-earned cash. If you're working a 9 to 5, chances are you've heard of a 401k. But that's just the tip of the iceberg. There's also the IRA, the Roth IRA, and for the self-employed, the SEP IRA. These accounts are more than just alphabet soup. They're your ticket to tax advantages that can save you a bundle. Starting with a 401, especially if your employer offers a match, is like getting free money just for competence. It's a no-brainer, but don't stop there. IRAs can offer even more tax benefits, and the Roth IRA, that's a potential goldmine with tax-free growth. Yes, you heard that right, tax-free. But let's not just rely on these accounts. Diversification is your best friend in the investing world. It's all about spreading your investments to minimize risk. Think of it like this. You wouldn't put all your groceries in one bag, right? So why put all your money in one stock or one type of... Now, if you're thinking, this sounds great, but I don't have the cash to start big, don't worry. That's the beauty of investing in your 20s. You don't need much money to make a significant impact down the road. We'll talk about how you can start small but think big in the next section. Stick around because we're just getting to the good part. Let's dive into the heart of the matter. Building that all-important investment portfolio. You might think you need a mountain of cash to start, but that's one of the biggest myths. The truth is, you can begin investing with the price of a weekly coffee run. The key is consistency and a little concept called dollar cost averaging. This means you invest a fixed amount of money regularly, no matter what the market's doing. Over time, this can average the cost of your investments and potentially reduce the risk of encountering unfavorable market conditions. But where do you put this money? If you're scratching your head, thinking about which stocks to pick, let me stop you. Individual stocks can be a roller coaster ride. For starters, consider index funds or ETs that track the market. This way, you're not putting all your eggs in one basket. You're spreading them out across a whole bunch of baskets, which is what diversification is all about. Now, you might be wondering about robo-advisors. These automated platforms can be an excellent tool for the hands-off investor. They use algorithms to build and manage your investment portfolio based on risk tolerance and goals. And the best part, they usually come with lower fees than a traditional financial advisor. But remember, investing isn't AI set it and forget it kind of deal. You must check in on your investments, understand their performance, and adjust as needed. That's how you stay on track to hit those big financial goals. Moving on, let's talk strategy. There's no one-size-fits-all approach to investing, but some tried-and-true methods can help you succeed financially. One of the most effective strategies for new investors is dollar cost averaging, which we touched on earlier. By investing a set amount regularly, you can temper the market's volatility. It's like autopilot for your investments, and it keeps you disciplined about contributing without trying to time the market. Another strategy is to focus on low-cost index funds or ETFs. These funds aim to mirror the performance of a specific index like the SP 500. They're a favorite among financial advisors for a reason. Historically, they've tended to outperform actively managed funds, especially after you account for fees. Speaking of fees, always keep an eye on them. Over time, high fees can eat into your returns like nothing else. Now, let's talk about the elephant in the room: risk. It's a fact of investing life, but not all risk is created equal. In your 20s, you can generally afford to take on more risk because you have time to recover from market dips. But this doesn't mean you should throw caution to the wind. Understanding your risk tolerance is vital. It's about finding that sweet spot where you can sleep at night and have growth potential. As you grow more confident and your financial situation evolves, you might consider branching out into individual stocks or even other asset classes like real estate or cryptocurrencies. But remember, with higher potential returns comes higher risk. It's essential to do your homework and never invest in something you don't understand. Indeed, now, let's navigate the minefield of mistakes that can trip up new investors. First and foremost, avoid letting emotions drive your investment decisions. The market is a wild ride, and if you panic sell during a dip, you lock in your losses. Remember, investing is a marathon, not a sprint. Patience is not just a virtue, it's a strategy. Another pitfall is neglecting to diversify. It's tempting to pour all your money into the latest trending stock or sector, but if that industry takes a hit, so does your entire investment. Diversification is like having multiple streams feeding into a lake. If one dries up, you're not left high and dry. Now let's talk debt. High-interest debt, like credit card balances, can sabotage your investment efforts. The interest on that debt can outpace any returns you might make on your investments, so make it a priority to pay down high-interest debts. Lifestyle inflation is another silent budget killer. As your income grows, it's natural to want to increase your standard of living. But if you're not careful, you could have little to invest. Always aim to live below your means and invest the surplus. ARE. Lastly, don't overlook the importance of an emergency fund. Without one, you might be forced to liquidate investments at the worst possible time to cover unexpected expenses. Aim for 3 to 6 months' worth of living expenses tucked away in a high-yield savings account. As you become more comfortable with investing, it's time to start thinking about optimizing your portfolio for tax efficiency. This is where things like tax loss harvesting and understanding the tax implications of different investment accounts come into play. For instance, knowing when to use a traditional IRA versus a Roth IRA can significantly impact your after-tax returns. Another advanced tip is to consider looking beyond the stock market. Real estate, for example, can be a great way to diversify your investments and generate passive income. Platforms like REITs, real estate investment trusts, make it possible to invest in real estate without having to buy property directly. For the entrepreneurial spirits out there, starting a side hustle can not only provide extra income, but also offer new avenues for investment. This could be anything from freelance work to launching a startup. The key is to find something you're passionate about that can also generate income. And let's not forget about the power of rebalancing your portfolio. As markets move, your investments can drift away from your target allocation. Regularly rebalancing ensures that you maintain your desired level of risk and can sometimes even boost your returns. Remember, becoming a millennial millionaire isn't just about making money. It's about making intelligent decisions with the money you have. It's about being consistent, staying informed, and always looking for ways to optimize your financial strategy. Thank you for watching. If you're ready to start your investment journey, take that first step today. It's never too early or too late to work towards your financial goals. For more tips and strategies on building wealth, subscribe and hit that notification bell. And if you have any questions or topics you'd like me to cover, drop a comment below. Until next time, keep investing, learning, and growing your wealth.